Good morning, everyone. My name is Asad Jaffrey. Today, we will be discussing the Intel R&D accounting case study. The purpose of this case study is to look into the accounting methods for the R&D and compare the expensing versus the capitalization methodologies. With that in mind, let's jump into the questions. So question one is about what R&D is and summarize the accounting treatment for the R&D under US GAAP. So R&D stands for research and development, and it basically talks about the activities that a corporation pursues in order to innovate, develop, and test new products and services. The accounting treatment, according to the US GAAP, is that if the R&D is internal, R&D expenditures are expensed on the income statement as they are incurred. However, if the R&D is via a third party, for example, through an acquisition of another company, then R&D expenditures are capitalized over the useful life of the product, and that's how the accounting treatment of R&D is done today, according to the US GAAP. Question two. Question two is about whether or not we should expense or capitalize R&D, and which method is better for understanding the underlying economics of the firm. So whether we should expense it or not, it depends on the useful life of the product that R&D produces. If the product generated or produced by the R&D is utilized within the year it is produced, then it is better to expense it, because all the benefit is utilized within that same year. However, if the benefits of the R&D is stretched across multiple years, in other words, if the useful life of the product is multiple years, then capitalizing gives a better picture of the underlying economics of the firm. Question three.
So in the case of Intel's R&D, question three asks about whether they generate economic benefits over the short run or over a longer horizon. And they, absolutely generate benefits over a longer horizon. I think their accounting standard doesn't properly capture this, as they're currently expensing their entire R&D expense within the year it's incurred, which would show that they're generating all the benefit from that R&D within the same year. And so I don't think that really coincides well. So next one. Yeah, question four asks about the opinion of creditors, which one they would like better, whether R&D is expensed or capitalized. And this is interesting because I think it goes against what we've kind of discussed so far, because creditors have a little bit of a different perspective. They're in the business of lending money, and when they're deciding on who they're going to lend money to or which company, the main thing they care about is how well that company is going to be able to service those debt payments and ultimately pay back the loan. And so I think in the case of Intel, creditors would prefer that R&D is expensed entirely the year that it's incurred, because it more realistically shows their ability to cover interest payments. If it was capitalized, that would lower their R&D expense and increase their net income, kind of overstating their ability to service loan payments. And just more simply, if they expensed R&D in the year that it was incurred, it would properly show the profits left over to cover potential loan payments. So next one.
Question 5 is asking for us to quantify the lower bound of future benefits associated with R&D and how we would do this. We found this to be an interesting discussion question with a couple of different approaches. One approach is that you might not get any in return from your investment at all. You might be putting some R&D into something only to find it's a flop. You're not going to receive any benefits as a result. So we're kind of using Google Glass here as an exaggeration, but you can see this as an example where you put in this research and you don't get the benefit as a result. So your lower bound would be 0 benefit. Next slide. But we can also assume that rational companies would only pursue R&D if they expect to get some kind of gain from it, or at least not get a loss, especially from an accounting perspective. If you're putting this down on your balance sheet or something like that, and you're writing down that this will lose you money, you're not going to conduct that R&D. So we might make an assumption that R&D is only conducted if we break even, where the lower bound of economic benefit is equal to the expenses related to R&D. This is kind of similar to the process of capitalizing R&D. Next slide. And then one last point on this is that there is also an edge case where it's conceivable R&D might lead to negative future effects, even beyond the cost of the R&D itself. For example, Shell Oil in the 1980s researched global warming and found that they were actually a huge contributor to it, and this was bad news. They tried to conceal this, it eventually came out, and there was a huge backlash against the company as a result. And so you could argue that the result of their R&D led to negative future impacts to the company. Similar to the last slide, we can assume that rational companies aren't going to knowingly pursue this kind of research. It's a little bit like big tobacco sponsoring research into the negative health effects of smoking.
So for questions 6 and 7 are about journal entries for capitalization for R&D. Our group kind of took both approaches on reporting this journal entry, both from scratch as well as from adjustment perspective. So for question 6 is asking about financial positions of R&D in 2008. Since R&D expenses in 2008, 5722 million, we need to subtract the cost from expenses from the income statements and add it back to the balance sheet. So we debit intangible assets for R&D for 5722 million and a credit cash or account payable for the same amount. If we were choosing to adjust the existing journal entry, we'll debit intangible for R&D for 5722 million and debit R&D expenses for the same amount. For question 7, we'll assume the residual value for capitalized R&D is 0 and amortization is happening on a straight line basis. So 2009 is actually the year 1 for amortization, which is 572.2 million. So the journal entry in 2009 would be we debit amortization expenses for 572.2 million and a credit accumulated amortization for the same amount. But if we're adjusting journal entries from this original financial statements, besides what we have, we will also need to debit intangible for R&D for 56 to 53 million and a credit R&D expenses for the same amount.
So question 8 is asking us to assess the impact on the income statement. Similar to question 6 and 7, we assume no residual value for the capitalized R&D and a straight line approach for amortization. The R&D cost in 2008 through 2012 are capitalized and then amortized over a 10-year period. For example, the R&D cost in 2008 is amortized in year 2009 to 2018. And similarly, we'll have the 1/10 of the R&D cost in 2009 in year of 2010 to 2019 and etc. And the total amortized expense will in 2010 includes 1/10 of the R&D cost in 2008 and 9. So we have $1,137 million. And similarly, we can get $1,795 million for 2011 and $2,630 million for 2012. Then we grab the actual reported pre-tax income from the income statement, and then we add back the R&D cost because it's been capitalized, and then we subtract the total amortization expense, and we got the pre-tax income under R&D capitalization. And then comparing these two pre-tax incomes, we calculate the percentage difference as 33 for 2010, 36% for 2011, and 50% for 2012.
Question 9 requested that we assess the resulting impact of capitalizing R&D on the 2012 balance sheet. So based on the details of the previous questions, we began capitalizing the R&D expenses in 2008. These capitalized values were debited to the intangibles R&D account on the balance sheet. In the following years, the additional R&D expenses were also capitalized and debited to the intangible R&D account. Additionally, the amortization of the prior year's assets was credited to the same account. By continuing this method, we end up getting a final R&D asset value of roughly 30 billion for the end of 2012.
And then for this question, we were looking at if we capitalize the R&D for end of year 2012, and we have two different journal entries. The first one is the R&D expense for the year. We debit it and then credit cash. And then we also debit the amortization expense for the year. And then we credit it to our R&D account. And on the right is just a combined journal entry.
So we were next asked to calculate the ratio of the intangible assets to the long-lived assets in both the actual ratio or so the actual scenario using the reported Intel data. And then we were asked to do the same thing for the pro forma scenario where we were capitalizing R&D. A couple of technical notes, kind of when looking at the balance sheet, we thought that kind of under the intangible asset class, the only items that we saw on the balance sheet were goodwill and the identified intangible assets. And then kind of similarly for the long-lived assets, the only item that we thought was sort of pertinent to that category was the PP&E. So taking those values, summing them up and kind of comparing them, we see in the actual scenario, our ratio is 0.57. And then in the pro forma scenario where we capitalize the R&D, we came up with a value of 1.43. It's kind of important to note that that value is calculated using the sort of under the assumption that we've been capitalizing R&D since 2008, which was kind of calculated in questions 9 and 10. And we kind of think that the better value is the pro forma ratio where we are capitalizing R&D because it gives a better picture of sort of how assets are distributed or sort of what comprises the assets. Obviously, like in the first scenario with Intel or in the actual ratio where we get a ratio of 0.57, that's kind of suggesting that Intel's like, a majority of Intel's assets are in their PP&E, which is clearly not what they do. But in the pro forma ratio, we see that a majority of their assets are actually in their sort of intangible asset class, which makes sense because they go do a lot of R&D. Question 12.
So question 12 asks us to compute the actual and pro forma book value of equity and the market to book ratios as of the end of 2012. So in 2012, the actual book value of equity was 51,203 million, and the market to book ratio was 2.03, whereas the pro forma 2012 book value of equity was 81,517 million, and market to book ratio was 1.28. So the original ratio is relatively high, making it seem as though investors overvalue Intel Core by 2 times its book value. However, the new pro forma ratio using the R&D capitalization reveals that it is not as overvalued as it seems. So the value that the market places on Intel is more reasonable, and the pro forma ratio makes better sense of this.
So our key takeaway from this case were like firms such as Intel with R&D investments likely to generate economic benefit over a period of time should capitalize the expenses. Pre-tax income is higher when R&D is capitalized rather than expense. So this shows an increase in profit as well as the tax burden. R&D capitalization increases the asset and retaining earning of the company. And capitalizing your R&D gives a clear, more conservative view of the company's true profitability. So this also allows for fair comparison between company's historical performance and also performance with peers. Thank you very much.